There are moments in our journey toward financial mastery when the path ahead feels shrouded, not by darkness, but by a dazzling array of lights, each promising to illuminate the one true way. You've sought clarity amidst the din, yearning for wisdom that cuts through the superficial, for a truth that resonates with the quiet strength of data, not just market chatter. Perhaps you've embraced the elegant promise of factor investing, drawn by its seemingly scientific approach, its mathematical precision, the allure of systematically capturing market premiums. It feels like a homecoming, a place where logic reigns. Yet, even in the most well-tended gardens, hidden roots can intertwine, unseen, beneath the surface. Have you ever felt that subtle tremor of doubt, a quiet whisper that asks if what appears robust might hold unseen vulnerabilities? It's a profound discomfort, isn't it? This feeling of being adrift in a sea of conflicting information, of wrestling with theories that sound impeccable on paper but feel fragile when faced with the unpredictable currents of the real world. Many have walked this path, carrying the weight of past missteps, the anxiety of future unknowns, and the frustration with advice that feels more like a sales pitch than a guiding light. You seek not just answers, but understanding, a bedrock beneath the shifting sands of market narratives. For too long, the narrative around factor investing has been one of unassailable logic, a beacon promising systematic outperformance, a scientific path to alpha. It's easy to be swept up in this current, to adopt these strategies blindly, believing we are riding the wave of undeniable truth. But we must pause and ask ourselves, truly ask, are we conducting a thorough analysis of these strategies, or are we simply following the latest market dogma, missing crucial underlying vulnerabilities that could impact our portfolios? Benjamin Graham, the quiet sage of value, reminded us with profound clarity, an investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are speculative. His words are not just an echo from the past, they are a living compass for our present. Today, we journey beyond the polished façade of factor investing. We will peel back the layers, not to dismiss its potential, but to truly understand its full spectrum. We're not just looking at the returns, we're seeking to comprehend the underlying mechanisms, the subtle dependencies, and yes, the hidden risks that can silently erode the very wealth you meticulously build. We're uncovering the hidden truths behind wealth accumulation, daring to challenge the consensus, and inviting you to find your true edge, rooted in a deeper, more intimate understanding of the market's intricate dance. Don't just invest, understand the why behind every decision. This exploration is for those who dare to look closer, to feel the texture of the numbers, and to build with foresight and resilience. Have you ever felt the silent dread of meticulously constructing what you believe to be a truly diversified multi-factor portfolio, only to witness all your supposedly independent factors crashing in unison during a systemic shock? It's a profound moment, isn't it? A chilling realization that the very foundation of your diversification, the bedrock of your financial peace, might be built upon a misunderstanding of market resilience. This isn't just about financial loss, it's about the unsettling feeling of betrayal by models that promised safety, leaving you adrift in a storm you thought you were prepared for. The common distortion, often perpetuated by simplified models and product marketing, is that factors like value, momentum, and quality operate in isolated silos, each contributing unique, uncorrelated alpha. We are led to believe they are distinct streams, flowing parallel, never converging. This belief fosters a false sense of security, a warm blanket of diversification that, under pressure, can dissolve into thin air. But the market, in its wisdom, often reveals truths far more complex than our neat academic constructs. The shattering, counterintuitive truth is this: during periods of extreme market stress or profound regime shifts, factor correlations can spike dramatically. What once appeared independent suddenly moves as one, exposing hidden systemic risks and obliterating the illusion of robust diversification. It's like a complex, interconnected bridge where each support beam is engineered for independent load-bearing, only to discover a critical, unseen flaw in their foundational connection, causing a simultaneous collapse under unexpected strain. This isn't a theoretical exercise, it's a lived reality for those who have weathered true market tempests. To truly understand this, we must engage in a deeper analysis. Consider a three-step quantitative technique. First, analyze historical factor correlation matrices, not just averages, but across different market cycles and economic regimes. Second, identify specific periods of unexpected convergence, looking for those moments when supposedly uncorrelated factors suddenly moved in lockstep. Finally, construct stress test scenarios for your multi-factor portfolio, simulating these convergence events to uncover latent interdependencies. Are you truly prepared to face the ghost in the machine, the hidden force that can sabotage your diversification when you need it most? Have you felt that creeping doubt, a quiet unease that your meticulously chosen factor strategy is slowly bleeding its edge? It's not just the ebb and flow of normal market cycles. It's a deeper, more unsettling feeling that the very alpha you sought has been arbitrarily arbitraged away, or perhaps was simply a statistical anomaly from the outset. This doubt gnaws at the soul of an ambitious investor, doesn't it? The frustration of pouring your intellect into a strategy only to see its promise dim, leaving you questioning the very foundations of your market understanding. There's a widespread distortion in the financial world, a pervasive belief that once a factor is discovered and published in academic literature, its premium becomes a permanent, exploitable market inefficiency. We often embrace this idea, thinking we've found a perpetual motion machine for returns. But the market, in its ceaseless dance of discovery and efficiency, rarely allows such static opportunities to persist. It's not a fixed landscape, it's a living, breathing entity. The empirical truth, revealed through rigorous quantitative analysis, is often far less forgiving. Many once powerful factors exhibit significant decay post-publication. They become victims not just of market efficiency, but of data mining biases and the very capital flows that rush in to exploit them. What began as a genuine signal, a whisper of inefficiency, can quickly become statistical noise, diluted by the collective pursuit of its promise. Chasing factor alpha is akin to prospecting in a gold rush town. The easy nuggets are quickly picked, and what remains requires exponentially more effort for diminishing, often illusory, returns, leaving many with empty pans. To navigate this mirage, we need a critical thinking framework. Go beyond superficial statistical significance. Emphasize deep economic intuition. Does this factor make sense in the real world, beyond the numbers? Demand out-of-sample testing across diverse market conditions, not just the periods that validate a backtest. Most importantly, conduct a realistic assessment of the cost of capital required to exploit the factor. What are the transaction costs, the liquidity constraints, the behavioral hurdles? Is the true alpha net of these realities still compelling? Are you truly understanding the fleeting nature of these market phenomena, or are you clinging to the ghost of yesterday's premium? Have you ever felt that unconscious anxiety, a quiet whisper that your deeply ingrained psychological tendencies, perhaps confirmation bias or overconfidence, are subtly guiding you into factor strategies at precisely the wrong market junctures? It's a profound discomfort, isn't it? The thought that your own mind, intended to be your greatest asset, might be transforming perceived strength into hidden portfolio vulnerability. This struggle is real, a silent battle fought within the very heart of your investment decisions. There's a common, yet dangerous, distortion that quantitative, systematic factor investing somehow renders investors immune to behavioral biases. We often believe that by relying on data and algorithms, we transcend the emotional pitfalls of traditional stock picking. But this overlooks the pervasive human element in factor selection, in the timing of entry and exit, and in the emotional commitment to, or abandonment of, strategies. The machine may be unbiased, but the hand that feeds it, and the mind that oversees it, remains profoundly human. The profound truth, revealed by behavioral finance pioneers like Daniel Kahneman, is that investors frequently exhibit recency bias, chasing past factor performance with an almost magnetic pull, or, conversely, they succumb to loss aversion, abandoning underperforming factors too soon, systematically buying high and selling low within factor cycles. This isn't a flaw in the factors themselves, but a deeply human tendency to project the immediate past onto an uncertain future. It's like navigating a complex financial landscape with a state-of-the-art map, but unknowingly wearing cognitive blinders that only highlight the paths you want to see, leading repeatedly into predictable traps. To truly master this paradox, we must engage in rigorous self-awareness. Consider a self-assessment and portfolio audit inspired by insights from thinking, fast and slow. This involves identifying your personal behavioral biases in factor selection, honestly evaluating your rebalancing decisions, and fostering disciplined adherence to your long-term plan, even when the market whispers doubts. Are you truly making objective choices, or are your biases amplifying the very risks you sought to mitigate? Have you ever felt that gnawing concern, a quiet unease that your portfolio's factor allocation, while mathematically elegant on paper, is fundamentally unscalable or vulnerable to sudden market shifts? It's an unsettling thought, isn't it? The realization that the sheer volume of capital now chasing the same smart opportunities might be creating an invisible ceiling on your potential returns. This isn't just about imperfect execution, it's about the real-world friction that spreadsheets often fail to capture. There's a widespread distortion, a comforting illusion, that successful factors possess infinite capacity to absorb capital without degrading their premium. We often overlook the practical limits imposed by market liquidity and the finite nature of true arbitrage opportunities. It's as if we believe the market is an endless well, capable of satisfying every thirst, when in reality it's a dynamic ecosystem with delicate balances. This oversight can lead to a profound disappointment when theoretical gains evaporate in the crucible of real trading. The harsh reality, derived from sound capital allocation principles, is this: as more capital floods into a factor, a subtle but relentless erosion begins. Transaction costs rise, liquidity diminishes, and the very act of trading, especially in size, starts to consume the factor's edge. This creates an invisible ceiling on its profitability and future returns, turning a once clear signal into a muddled echo. A factor strategy is like a pristine, small fishing ground. For a few early bites, it's bountiful, but when the entire fleet arrives, the fish disappear, the waters become turbulent, and everyone goes home with diminished or even empty nets. To navigate this challenge, we must move beyond the spreadsheet's perfect world. Consider adopting a forensic accounting approach to assess the true liquidity and capacity of specific factor exposures within your portfolio. This involves analyzing average daily trading volumes of the underlying assets, scrutinizing bid-ask spreads for signs of illiquidity, and deeply understanding the concentration risks embedded in the holdings of factor tracking instruments. Are you truly accounting for the real-world friction, or are you building a magnificent theoretical structure that cannot bear the weight of practical application? Have you ever faced that unsettling realization, a cold wave of doubt, that your once stellar factor strategy is now inexplicably underperforming? It leaves you questioning everything, doesn't it? The fundamental validity of the strategy, your own investment judgment, and the very premise of systematic outperformance. This experience can feel like a betrayal, a loss of trust in the very principles you meticulously studied, leaving you searching for solid ground in shifting sands. There's a common, yet dangerous, distortion that factors deliver consistent outperformance across all economic and market regimes. We often fall into the trap of believing they are universal remedies, always potent, always reliable, but this overlooks their inherent cyclicality, their profound sensitivity to macroeconomic conditions, and often their pro-cyclical tendencies. The market is not a static canvas, it is a dynamic, ever-changing landscape, and what thrives in one season may wither in another. The critical insight, drawn from a deep understanding of macroeconomic analysis and historical market context, is this: factors are not static. Their efficacy is often regime-dependent. A value factor, for instance, might thrive during a post-recession recovery when distressed assets rebound, but it could flounder in an innovation-driven bull market where growth stocks dominate. To cling to a static allocation, a set-it-and-forget-it approach in such a dynamic environment is to expose your portfolio to perilous winds. Relying on a single factor across all market conditions is like entrusting your journey to a ship designed only for calm, predictable waters, expecting it to navigate both violent storms and long periods of doldrums with equal proficiency and safety. To build true resilience, we need a strategic asset allocation framework that incorporates an understanding of distinct market regimes. This means actively identifying periods of inflation, deflation, high growth, or recession. It means dynamically adjusting factor exposures rather than clinging to a fixed belief. Are you truly listening to the market's whispers about changing tides, or are you hoping yesterday's map will guide you through tomorrow's uncharted waters? We have journeyed through the subtle currents and hidden depths of factor investing, unveiling aspects often obscured by the allure of systematic returns. We've felt the silent dread of factor interdependencies, where supposedly diversified assets crash in unison, revealing a profound misunderstanding of true market resilience. We've grappled with the mirage of alpha, recognizing how once powerful factors can fade into market noise, victims of their own popularity and data mining biases. We've confronted the investor's paradox, acknowledging how our own deeply ingrained psychological tendencies can amplify factor risks, turning perceived strength into hidden vulnerability. We've explored the real-world friction of factor capacity, understanding that even the most elegant strategies have limits in a market flooded with capital. And finally, we've navigated the shifting sands, realizing that factors, far from being static, are cyclical, their efficacy dependent on the unique rhythms of each market regime. Factor investing, in its essence, is a profound tool, a powerful lens through which we can seek market efficiencies and build robust portfolios. But like any powerful instrument, it demands not blind faith, but a deep, reverent understanding of its edges, its limitations, and its true nature. It is not a dogma to be followed without question, but a framework that requires continuous critical analysis and disciplined application. This path demands more than just adopting a strategy. It calls for an intimate connection with the data, a willingness to deconstruct market narratives, and the courage to connect complex theory to practical, profitable, and ethically sound application. The call now is to move beyond superficial adoption, to embrace rigorous, data-driven analysis, to truly master your portfolio rather than simply being managed by its perceived certainties. This is the essence of true financial independence. Warren Buffett, with his characteristic clarity, offered a timeless truth that resonates deeply with our exploration. Risk comes from not knowing what you're doing. Our journey through factor investing's hidden risks underscores the profound importance of truly knowing, understanding, and actively managing your investment choices. Take a moment, in the quiet solitude of your own reflection, to truly feel the weight of this wisdom, to examine your own portfolio portfolio, not with fear, but with an open, inquiring heart. Are you truly seeing the whole landscape, or are there still hidden roots, unseen dependencies, waiting beneath the surface of your well-tended garden?